Which fund would you choose? Fund A or Fund B? Let me give you the background. We have both go back to 2009. Fund A has averaged 9.37. Fund B has averaged 13.7. Fund A has averaged 9.3 to be precise, 9.3, with much more volatility than Fund B. All right, so Fund B has averaged 13.7 with less volatility than Fund A did. $10,000 invested in Fund A from 2009 to June of the end of 2020 would be worth $27,000 today. $10,000 invested in Fund B would be worth 58% more than that, roughly $43,000. Which fund would you choose? Now, and I'm serious. So think about it. Which fund would you choose? All right, so let's look at this. This is nuts. I think you know where I'm going here. If Buffett were a fund manager, if you were to ask investors who's the greatest investor of all time, Buffett's name would be near the top of everyone's list. His two great contributions have been that he taught investors to have a value approach and that he preached the importance of patience and discipline. The latter contribution is evident among the Berkshire Hathaway shareholders who have a religious belief and confidence in him. An interesting question, though, is how would Buffett be viewed if instead of being the chairman of Berkshire Hathaway, he ran an open-end mutual fund? Would the same Berkshire shareholders who religiously hold their shares have the same patience and discipline? Before answering, let's read the numbers. I just told you that. Buffett, BRK, has returned 9.3% since 2009. Vanguard's S&P 500 has returned 13.7%. The difference is a 58% increase in return in actual dollars in the S&P 500. In the more recent period from 2017 through 2020, Berkshire has only returned 2.6, whereas 11.9 for the S&P 500. Over this period, the volatilities were virtually identical. The total return difference was 9.5% for Berkshire, 48.3% for the S&P 500. In my 25 years of experience as an investment advisor, says Larry Swedroe, man, he's only got as much experience as I do. That's crazy. That's weird. I've been doing this 25 years too. I've learned that one of the greatest mistakes investors make is that when it comes to judging performance, they treat 3 years as a long time, 5 as a very long time, and 10 as an eternity. And given that BRK has underperformed for more than a decade, if Buffett were a fund manager, many investors would have bailed just as they bailed on Bill Miller, which was the only fund to ever beat the S&P 500 15 years in a row, 1991 to 2005. Now, I think I've shared with you my when I used to work at Legg Mason, and they used to push Bill Miller like crazy because he was the only guy to beat the S&P 500, and everybody's like, "Oh my goodness, if he beat him, he must beat him going forward." So, in the end of 2005, the Morningstar report had Bill Miller, the Legg Mason Valley Trust, as a 5-star rated fund. And don't forget, the Legg Mason Valley Trust had a pretty significant fees, like 1.86, 5-star rated fund at the end of 2005. About 18 months later in 2007, because his investments took it on the chin, or maybe the end of 2006, I can't remember. But 18 months later, after being a 5-star rated fund, he was down to 2 stars. Now, I'm not sure if he ever went to 1 star or not. He might have. Because he bought a bunch of crap, Countrywide, I think a bunch of bank stocks and whatnot, and they got killed. So after that, Bill Miller, you wouldn't even give him $1 under a bridge if he begged for money. You're like, hell no, Bill Miller, you suck. And Morningstar had a 2-star. I mean, literally, I always said, well, in 18 months, did Bill Miller lose his mind? I mean, literally, did he go crazy? No, it was just he picked the wrong investments. And even Bill Miller said he just got lucky. In fact, it was the last day of 2005. I remember being in the office. He was down relative to the S&P 500, like a couple of days before that, and the last 2 days of trading in the year, he had a little bit of a rally to overcome the S&P 500. I remember the sweat was wiped off the brows of many an advisor at Legg Mason. It was weird. All right, so let's keep going down here. And it was just luck, and he said it too. All right, so but here's Legg Mason Valley Trust, LMVTX. They call it ClearBridge now. And we can see in 2006, he got killed by the S&P. 2007, he got killed. 2008, he got killed. 2009, he beat it. 2010, he got killed. 2011, he got killed. So he beat the S&P 500 for 15 years running. Then the next 6 years, he got smoked in 5 of the 6 years. And investors fled with abandon. His performance eventually led to his departure from Legg Mason in 2012. And this was the man who had done what no fund manager had done before or since. But his departure came just after 6 years. Buffett has been underperforming for about twice as long, suggesting that if he were a fund manager and not the chairman of Berkshire Hathaway, investors would not have remained as loyal. Before concluding, let's take a look at another period for which Berkshire underperformed, the dot-com era. From January 95 through March of 2000, Berkshire Hathaway underperformed S&P 500 by 5.8% per year and did so while experiencing twice the volatility. If you lost faith in Buffett and value investing in general due to this period of underperformance, you would have missed out on Berkshire's spectacular outperformance over the next years. From 2000 April through December 2008, Berkshire returned 6.8% a year, where the S&P 500 lost 4% a year. Reviewing the 2000 to 2008 is important because it'll follow the very same outperformance of growth stocks that occurs since 2017. I'd even go back to about 2010. In both cases, all of the outperformance of growth stocks are due to increasing relative valuations, not positive earning surprises for growth stocks or negative one for value stocks, just increasing valuations. The increasing PE ratios is what that is. The earnings aren't popping. It's just the people are willing to pay higher dollars for the same amount of earnings. At some point, it's going to come back to bite you. This is why I'm still in VTV, man. I cannot fathom. Having seen this myself and witnessed it firsthand with people who made huge investment mistakes, I just cannot get out of VTV. Just because you're willing to pay $30 for $1 of earnings doesn't mean the stock that you're buying is worth $30 for $1 of earnings. At some point, you got to come back to normalcy. And normalcy, it's not $30 for $1 of earnings. Normalcy might be $20 with low interest rates, but certainly not $30. No way, no how. Consider that we have now lived through the greatest drawdown of values performance in history by a wide margin. That has left valuations at the cheapest level in history relative to growth stocks. There you go, VTV. Valuations are the cheapest level in history relative to growth stocks. This is basically true all around the globe. Every time we have a period like this, the returns to value eventually recovered. And once the recovery began, it was massive and swift. For example, at the end of March 2000, value had done so poorly over the prior 5 years that it underperformed growth over the 1, 3, 5, 10, 15, 20-year periods. But just 1 year later, it outperformed all those periods. So does that make sense? At the end of March of 2000, value had done so poorly relative to growth for the previous 5 years that for every single reporting year, 1, 3, 5, 10, 15, 20, value underperformed growth. But just 1 year later, all that changed. The question for Berkshire investors and value investors generally, this guy, having endured the pain of underperformance, is it wise to bail out when there's little evidence supporting the idea that growth stocks should be expected to outperform value stocks going forward? Remember, there's no regime change whatsoever. Growth has not outperformed because the earnings have done better relative to value. It has all been about changes in valuations. And he says speculation. I call it price earnings increase. Buffett knows what all financial economists knows. 10 years is likely nothing more than noise when it comes to return of risk assets, which is why we diversify, not run from risk. We diversify because we don't know which risk asset will be the next one to go through a long period of bad performance, and we don't want to run the risk of concentrating our assets in that class. So had you invested in a fund run by Buffett, would you sell? And you can read the comments here, which I got one. I think it's a great article. I think it's fantastic. Now, Swedroe, if memory serves, he's with Buckingham. I think Buckingham, let's see. Yeah, for Buckingham Strategic Wealth. And I think Buckingham is an affiliate. I'm sure they sell DFA stuff. I don't know. But anyway, if DFA is value-oriented, it's the equated index and stuff. And, you know, those guys are taking on the chin. I was watching a DFA, Dimensional Fund Advisors video the other day with, I think, the CIO, Chief Investment Officer, was basically begging to be listened to because value was so underwhelmed. He's like, look, hear me, please, please. I was like, man, it wasn't that long ago, the DFA, you had to beg them to be able to be invited to the party. Now it seems the exact opposite. But I love that article. Larry does good. I'll put a link in the show notes. But I mean, the truth is the truth. I mean, this is literally what happened. And it just seems to me we're going to go back into this. And when it happens, people say, I can't believe you didn't see the nosebleeds. And we're not at nosebleeds, but, you know, we kind of are for those 6 stocks. Amazon, Google. I mean, these are nosebleed. I hate to say that because everyone's like, Let's take a look what PE ratio is on Apple real quick. Is it Apple? Hold on a sec. All right, so Amazon PE ratio is what, over 100 if memory serves. 143. Okay, that's nosebleed. Apple, APLE, right? APPL, excuse me. APL, there it is. Apple is 29. That's not nosebleed. Google, was it Alphabet? Is that what they call it? The GOOG. Yeah, let's take a look at that. That's 30. That's not nosebleed. It's high, but it's not nosebleed. So we got Netflix. Netflix got to be insane. That's 81. So we got Facebook. Oh, Facebook too. All right, so Facebook. I don't know why people invest in Facebook. I mean, I get the advertising stuff. 31. That's not nosebleed. Even Twitter, is that publicly traded? I don't even know. Twitter, yeah, it is. It doesn't have a PE. So I don't know what Twitter, I just don't, I could care less. But if you take those 6 stocks, you got a couple, three with nosebleeds. One doesn't have an earnings, then 2, I think. Apple and Facebook with 30, maybe 3 with not nosebleed. So we got 3 with nosebleed PE ratios and 3 with high but not nosebleeds. And of the 3 with nosebleeds, Twitter has no earnings. So there you go. I mean, you're paying $38 a share for they lost per share of 16 cents per share. Crazy. All right, I thought you might find this interesting. Love to hear your comments. And again, which fund would you invest in? We'll see ya.